Hey everybody, Preston Bryn here with our weekly roundup brought to you by our trader user group. Boy, this is for the trading week ending, what is it, D7 2018. We're coming into the final stretch of the year, and there's going to be a big fight between the Grinch and Rudolph. Which one's going to win? We're going to have a Merry Christmas and a strong finish, or is the Grinch going to come in and take everybody's presents away? Tear up the Christmas tree and all the other holiday goodies, and leave everybody wondering what the heck happened. Well, it's really been interesting. We had the month of October, which was the worst month start to the fourth quarter, but it was the worst month since 2008. It closed down 7.2%. The For the S&P, the Dow was down for the month 5.4%, and Nasdaq was down 9%. That was October to kick things off, and then in November, um, we saw the S&P bounce back up. It was up 2.14. The Dow was up 2.15. Nasdaq was relatively flat because technology is getting crushed. And then as we come into this first part of December, it was really interesting. We saw this past week, not this past week, but the week before, the S&P was down 4.6% for the week. The Dow was down 4.5%. Nasdaq was down 4.93% for this past week. It was really a really wild week. We started off strong, but it really finished pretty weak. VIX, the prior week, closed out the week at 18.07%, and this week, this Friday, it closed out at 23.23%. So the VIX, the volatility gauge, was up 28%. So needless to say, it was a very rough week, very tumultuous week, a lot of twists and turns to the week. From a sector performance standpoint, the best performing sector was utilities. Believe it or not, they finished up for the week 1.3%. The worst sector was XLI, the industrial sector. It was down just slightly under 6%, coming in at 5.94%. Current PE ratio on a go-forward 12-month basis is right at about 16.02%. This time last year, it was at 22.64%. So we've seen almost 29.2% reduction in PE ratio. So valuations are getting a little bit better as we move forward. This past week, we also saw about 1.4 trillion being taken out of stock portfolios here in the U.S. This was the worst start, as I said, to December since 2008. Really bad start. And October, the entire month of October was worst month since 2008. The start to December is the worst. This past week was the worst since 2008. So we're really getting some hard numbers in here, because for those of you that weren't trading back in late 07, going into 08, into end of 08, into the bottom that was formed in March of 2009, really tough times. So we're seeing some huge swings in the market here, and we're seeing economic slowdowns from falling commodity prices, weakening corporate profit projections on a go-forward basis. Housing and auto is kind of taking a little bit of a hit. Throw in there some trade uncertainty, where you have Navarro coming out and saying things, look, in 90 days, we're going to go full tilt boogie to the left, and we're going to hit them at 25%. And what we're asking for is for China to change their decades-long economic setup, and the way they're approaching the markets, and they think we're going to get it done in 90 days is totally ludicrous in my mind. But anyway, he comes out and makes that statement. The markets sell off, 400 points, 500 points, and that was just, he did that after we got some news where good news from from the more conservative, clear thinking individuals from the administration, who said that things are looking good, we're moving forward, so forth and so forth. So you get a lot of mixed messages out of the administration. I think, to me, if they just kind of keep quiet and not do their negotiations in front of CNN and CNBC or Fox Business, and just do all their negotiations behind the scene, and just put some super glue on those lips and just be quiet would probably help, because the markets are reacting to everything. That's what we're seeing so far. Meanwhile, the Feds, Powell has taken a change of heart from his early statements in early October, right? I mean, he came out early October and said, we're far from neutral. We got a lot of hikes to go. And the dot plot of 4 back then made sense. The markets immediately sold off. The bond market was saying there's only going to be 2 more rate hikes between when he made those statements in October and the end of 2019. One in December of this year and then one in 2019. And now the bond markets generally are right. The Feds haven't gotten any economic forecast right ever. They always look at trailing data instead of where the markets are now and what the markets are anticipating. So I think the Feds are a big part of the issue also. So they came out just recently and starting to back off their stance. I suspect in their meeting on the 18th and 19th, we'll see the dot plots come in from 4 rate hikes, but between now and the end of the year to maybe 2 or 3. They're going to bring that in a little bit. They're still going to overshoot. The bond market is only saying 2. 1 this Dece and then 1 sometime next year. And that could still change, but that's kind of what we're looking at. But that little thing there was enough to hike the markets up, but then it was shoved back down again when Navarro came out and made his statements. So these are just some things that are playing with the markets. What I've got on the screen here, just to show you the trials and tribulations of where the market has been going, this is a 240-minute chart. And you know, if you do the math there, it's just a little bit less than a day chart. But you can see here coming all the way back almost 3 weeks. This was our high, and this is our trading low. And you know, we've come in and we've tested the highs and the lows several times. We've done 3 tests up here and we've done 3 tests down here. Now, eventually one of them is going to break. Okay, and then that we're going to see a run. And then that run is going to carry us for a few days because the algos are going to kick in and really accelerate that run. If we break up here, the algo is going to kick it into the upside. If we break down here, the algos are going to kick it into the downside. Just looking at the charts, my belief is it's going to break down here and we're going to come down and test the lows made in February. Okay, that's kind of what I'm seeing here. But this just shows you this is almost, even in day trading, there's a lot of head fakes, as you can see on this 240-minute chart. Within the day trading or scalping, you have to be in and out really quick and be ready to take fast profits and then just get out if you're scalping these markets. And if you're swing trading these markets, then you can't be buying up here after a little bit of a run. You got to be looking at selling any kind of rally. And then down in this area here, you've got to kind of hold your breath and buy down around the bottoms down here and be ready to take fast profits. And that's been very difficult to do in these markets, especially when we're down in these areas down here. One thing I am noting is that on all the TV talking heads, there's a lot of doom and gloom. Typically, when there's a lot more doom and gloom, the markets tend to fare better to the upside. That's just human nature and what's called recency bias, where everybody tends to favor the most recent moves. So since we came from here down to here, the recency bias is going to say we're going to continue in this direction. I can't say that until I see a clear break here. If I see a clear break, then that's what's going to happen. That's kind of what I would see transpire. Now, if I just clean the chart up a bit and let's just step it out to a daily chart here and really go out just a little bit in time. In fact, let's take it out to a weekly chart here on the E-mini S&P 500 futures. You can see on this weekly chart here, I'm going to paint in the pivot high and pivot lows, and I'm going to paint in a market map. This market map shows where all the volume has taken place from the highs up here at 29.47 down to this market map here. This market map goes back almost a year. It goes back to March, about the middle of March, end of March of 2017. So a little bit more than a year on this weekly chart here. And you can see that the most of the trading volume has taken place right around the 2680 area. Now we're below that area, okay? And you can see on this volume here that if I just kind of widen the chart out so that you can see it just a little bit better, you can see this yellow bar here is where the bulk of the volume took place, which also happens to be around the 2018 open of 2675. And then coming down here, there's some more support down in this area here. You can see there's very little volume support at the 2018 lows of 25.29. That's why I believe if we take out this 2603, you're going to see some algos kick in, and we're going to come down to the 2018 lows very quickly. It could be a one-day event where people would consider that kind of a flush. Now, people thought we had a flush last time, but it wasn't. But it could be that fast. And then we may overshoot this a little bit, and then we can have some bounce back up into the 2600 area, another 80-point move back up, and we can jive around in this area a little bit. So keep in mind, we got the Fed coming up on the 18th and 19th with their policy statement and a press conference, which will be watched by all on the 19th. So that's not this coming week, but the week after, but it'll be very big. This coming week on Wednesday, we got the consumer price index, the CPI data. So all eyes are going to be on that for an inflationary or non-inflationary kind of event. Most economists forecast it coming in at 2.2% year over year. October, it came in at 2.5. So again, a little bit of a reduction in the inflation forecast for the consumer price index. So if we were to look at this and just say, okay, from the 2018 high to the 2018 low, what does that kind of work out for us from a percentage drop? And if I were to measure this and just kind of come in as, just kind of do a back of the napkin kind of thing, it's about a 14% move, okay? Right at about a 14% move off the bottom. Now, remember, in February this year, we were down about similar, 14, 15%. So that's why I think the markets just have an itch that they want to break this 2603 area and come down here. Now you can see this long-term trend line on here I'll back it out and show you where it originated from. But coming down to this long-term trend line would put us into a bear market at 21%. Now this would be hitting it by end of March of next year. If we break this area here, you can see this volume over price right here. We've got a pretty good support area right there, which is around the 17.5% down, around 2430. And then there's one final one right here at giving us 19% at about 2380. So call it 2400. So we've got a lot of support in this area here. This 2018 low is more of a psychological support because there's not a lot of volume that took place at the 2018 low. Okay, so that's why this thing is suspect. If we come down there, then we're going to just blow right through it pretty quick, and we'll probably come down to where more volume is hanging out around the 2425 area down to the 2400 area, which puts us around 19%. That'll be enough of a capitulation move to freak everybody out. Okay, and then everybody will be giving up, selling everything, including the kitchen sink. And that'll be enough where pretty much all the folks are cleared out of the market, and that'll leave us room to move a little bit higher, assuming the news continues to stay good. If we get any good news on the trade issue, if the Trump administration gets smart and gets their communication out to the public and to the markets, get it in sync instead of all over the place, that I think would help. So that's a little bit about what I'm seeing here. And of course, if I back it out, just to show you the origination of this trend line, and it goes all the way back, guys. So this is a long-term trend line that really starts at the lows in March of 2009. Okay, so that is the trend line. Now, that says that we can have an official bear market, yet still maintain this secular bullish trend. So remember, it was just someone's idea and definition that we're going to have we define a bear market as 20%. Okay, I mean, that's just somebody's definition. That's all that is. We can come all the way down here, be down a little bit more than 20%, but still be in a secular bull market. So just understand that. And we can flush everybody out and then get things squared away. I think as close as Trump watched the markets, I think he will figure out a way to send good news to the markets, probably call his people in a little bit, send good news to the market. That's kind of what the market is banking on as well, because Trump really just spends more time focused on the market than I think he should. Now, one other thing I wanted to show you, let me just blow it up really big here so that you can see it. If you look at this weekly candle, because this is a weekly chart right here, you can see this weekly candle. We opened up here, we closed down at the bottom, but it exceeded the boundary of the prior candle. Even though we closed a little bit higher than where we opened the prior week, it's still a bearish engulfing pattern. That is a bearish pattern, folks. And this is a weekly chart. So that suggests that if we have an inside day for the next day or two, meaning the highs and lows stays within the high and low of this weekly here on a weekly basis, we could have an inside day or an inside candle or two, which on this basis would be a weekly basis leading up to the Christmas holidays. We still, with that bearish gulfing, is going to be favored to come back down to these 2018 lows. Okay. The only thing that will get me off of that bent is if we come up here and we make new highs, we take out these pivot highs here, which is sitting around the 28-25 area. You can see these highs are slightly lower highs. They're perceptible, but not much. I mean, if I were to widen the candles out, you can see each high was slightly lower than the prior high. And probably the reason why is the algos, once price action got up here, the algos weren't waiting for it to get all the way up there, so they started firing off. Some probably started firing off early, and that caused others to fire off. And every candle, as you can see, that came up here, we sold off, we closed here, we opened, we couldn't get up, we sold off, we opened here, then we opened here, and we went all the way down to the bottom, right? All the way down here. Then we worked our way back up here, then we came back up, worked our way back up here, and then we sold off again within that 1 week period. So you can see these big, long red sticks on these weekly charts. And it does not take long to get down here, as you can see. I mean, from this open here, we could be down here in a day. All right. Like I said, this is at 26.36. And this is at 25.29. So you're looking at about 90 points, 85, 90 points, and one bad flush out day, and we're there. Okay. So I am still, as I've told my group and our members, I'm still neutral to bearish, but I've got a bearish tone. Okay, we've got this cross in the 50 and the 200. Anytime you've got that cross in the 50 and 200, you're in a sell the rally mode. Any kind of rally is worth selling. You can see this pivot high and pivot low here. We blew through them. We went above and below in 1 day. I mean, it really is. This candle here was not a bearish engulfing candle from the prior day's candle right here. Okay, I mean, we opened up, we came all the way down, we had a strong finish, we opened up, we started to move up, and then we sold off on Navarro and some of this other trade nonsense that they're talking about. So this is where we're sitting right now as we come into the new week. The momentum is still down. I would not be surprised to see a little bit of a bounce every time we get across in the 50 and the 200. Because it's delayed, we're usually well south of that cross point by the time we get the cross. And typically that means that the cross then becomes a little bit of like a magnet, meaning drawing prices to it. That would mean prices could possibly come back up to the 27.57 area, 27.60 area. And then if it got up in this area here, I would be more of an active seller than I would be a buyer right here. But I suspect most algos are going to probably have that ready to go anyway. So this is the craziness that we're in. If we look at NASDAQ, which is really taking a big bite, you can see NASDAQ, while still in the green for the year, the E-minis, S&P is in the red, but the NASDAQ is still in the green, but not by much. And at the rate that NASDAQ is moving, again, a blow off bottom, and we could make new 2018 lows for NASDAQ as well. All right. And of course, if we look at the Dow, which has been the strongest from a chart standpoint, I've said this before, you can see the 50 over the 200. It hadn't crossed yet, but we're in the red for the year. And you could see the low point. We're further away from the low. So the Dow has been the strongest of the bunch. Okay. but we've still had these wide swings and we make lower highs. So we're making a series of lower highs here. Here we're making higher lows. So we're kind of getting into this crunch in a very elliptical, I guess, triangle pattern. You can see all this volume over price here on the Dow sitting around 25,280. All right, so that'll kind of draw us up into that area should we get a lift early next week. So that's kind of what I'm seeing here. And then really the worst chart of all of them is in the Russell. And if we look at the RUT futures, I mean, you can see the crossing the 200 here happen before everybody else. And you can see, I've got to put it on here, the 2018 highs and lows, but we're down around the 2018 lows. If we come over here and we look at February of this year, this is the lows for the year for the RUT right here. Okay. So we've got a little bit of ways to go, but I think all markets just seem to want to test the lows of where we've been. Okay. That's kind of what I'm looking at here across all these indexes. Really amazing here. If we look at the FANG index, which is just an index of all FANG stocks, you can see this downsloping pattern here. We broke it, but we didn't really stay out of it, and we came right back down here. We broke it again, and now we're looking to transfix ourselves and come back down here again. So again, we don't have a cross yet in the 50 and the 200, but we've just had tremendous selling in the big high-flying FANG stocks. If we look at volatility, well, this is the VIX, and you can see here we closed the day in the rose-colored, almost red, not quite, but we closed, as I said, at 23.23. Prior week, we're at 18.07, so that was like a 28% uptick from the prior week. Notice since the beginning of October, we've been elevated right in this area here. Since we got the original Fed statement, or Powell statement in, I think it was October 2nd or 3rd, away we went. And we haven't looked back since. We spent almost all of our time in the yellow zone, caution zone. We moved into the light red zone briefly. We held it up here for about a week back in the middle of October, and then the 3rd week in October. And then we've just kind of briefly shot up in here. Now, should we come down and test the lows that we made in February? I think possibly you can see the VIX run up here near 30. Depends on how we approach those lows. If it's a one-day flush out, we'll come up here over 30 for sure. If it's not, if it's kind of a grinding lower, which that does not seem to be the pattern of the prices right now, but more of a fast and sharp move, then we'll have a big move in the VIX. So that is kind of one of the things that I'm seeing here as a possibility next week, right? I mean, just really doing that kind of number on the markets. If we look at the front month term structure, which is the VIX compared to the front month vol futures, we're in the red here too. And this red here, the dividing line is the 0 line, which means we're in a backwardation term structure, which means the VIX is higher than the front month volatility futures. And it shouldn't be that way. It should be less than. So the front month vol futures should be greater than the VIX. We're not. So when we're in a backwardation environment, that means there's a lot of fear out there. And you can see how we've been there really since almost, again, the early statement in October of Jerome Powell. And we've just kind of hovered in this area here. And you can see most of us, most of the time we spent right around this area here, this value area in the backwardation. And then if we look at the back month term structure, which is DEES compared to January, which is what drives VXX, a very popular ETF, you can see here we're well into backwardation. So that means there is a negative roll yield or a positive roll yield for VXX, which means it has a tendency, all else being equal, to move higher, not lower. As you guys know, longer term, VXX moves lower. But right now, the positive roll yield, because we're in a backwardation environment in the front month and back month vol futures, tends to give VXX a greater lift. So this is another thing that we got to be very careful of should the markets, if the markets just really plaster off, then we're going to see this thing really zoom up, and we're going to get some liquidations here. So just be careful with that. If we come down and look at treasuries with the bond market, as you can see here on this daily chart, we broke out of this pivot range. We've come up here and we've almost formed a new volume area here with all this volume coming in. I mean, it's really unusual, but you can see there's a volume area or a value area here at 142. You can see both the 200 EMA and the 50 EMA moving higher. You can see just this huge explosion. Once we took out that pivot high, it was off to the races. And that's what's had a tendency to flatten the yield curve. So bonds are strong. And if we look at the 10-year interest rates here, you can see, look at this. I mean, same thing. You can see this value area here where they've kind of just teardropped all the way down. They were up back in November around 322. Now they're sitting at 285. That's a huge fall in interest rates. I think they're going to find a little bit of a supporting bottom here. But remember, as the Feds reduce their dot plot, which is what they're forecast to do on December 18th, when we get an idea of just what they're thinking for 2019, that'll have a tendency to suppress interest rates further. So, and with these coming down like that, that'll have a tendency to affect the yield curve. So we just have to watch that very closely. Now, if we come over here and look at currencies, if we look at the dollar is near the 2018 highs. Up here, you can see the pivot high with this red bar, the pivot low here. You can see we're in this trading range, the value area sitting right here. And we have another one down here. I do believe the tendency for the dollar will be to drift lower if the Feds reduce their dot plot of what they're saying for interest rates. I think that's going to come in a little bit. And by the same token, because this is a dollar index based on other currencies, we're going to see the euro probably drift up a little bit. Okay. If you see the euro, we're sitting here in a pivot range. We're sitting in a value area within a pivot high and a pivot low. And then here's the overall value area going back about 150 bars, or I'm sorry, 90 bars. So for a little bit more than a quarter right here. And you can see where we're sitting right in this area here. So I think the odds favor euro moving up a little bit and the dollar moving down a little bit next week. Energy, if we look at oil is starting to find a bottom here. It is just, if you guys remember, and we had some members take the trade up in this area here, I was calling oil for the low 60s. Of course, it overshot and we just kept right on going down to the high 40s. Algos and people that it were loaded on the long side. If you looked at the commitment of traders report, it showed that everybody was long oil. And when you get everybody on one side of the boat tends to tip over, take on water on that side. And that's what it did. And oil just came undone. I mean, just look at this. This is a daily chart. I mean, there was only like 2 days where oil just held steady, but rest going all the way back to, it started in October the 11th. And we only had like one steady bar. And it went from October the 11th to November 26th. Every day was a down day, except for 2. I mean, almost a month, just tremendous liquidation of longs. Now we're trying to find a bottom down in this area. If we come out to a weekly chart, I'll show you where my longer term support area is. Looking at a weekly chart here, just stepping it out in time. You can see this big value area sitting here right at 48.20. I kind of draw, excuse me, I drew a light blue zone here as kind of a longer term support area. This candlestick here does me no good. We opened and closed a little bit lower for the week when OPEC came out and said they're going to decrease production to try and draw off some of the inventories. So this is where we're sitting right now. Excuse me. On oil. If we look at the spread between Brent and WTI, that production cut, excuse me, is going to keep the spread a little bit higher. Eventually, I'm going to want to short the spread. We did that before. This is a weekly chart. Let's put it in on a daily so that you can see it a little bit better. You can see on the spread, we shorted the spread up here. Made some good money on it. Now the spread is holding right in this area here. I think it's going to come back up to this area, and then I'm going to be willing to short the spread. You can do it in Thinkorswim for those that use Thinkorswim. I don't know if you can do it in Tasty Trade. You can do it in Interactive Brokers as well. All you do is you short Brent, and you go long WTI in the same ratio of 1-to-1. And it's $1,000 a point. It's an easy trade to do. It tends to have less volatility than oil because you can see here the spread's been fairly in just a range-bound mode. So these ranges are designed to be traded. But if you look at oil and Brent, I mean, even looking at Brent, I mean, this fell off the table too. It looks just like WTI. I mean, they both fell. This is Brent. And here's WTI, right? They both fell off the table looking at the daily. You can see these exhaustion bars down here. So that tells me we're going to find some support here. There's the shaded zone for WTI. So I don't think we'll get much lower than 48.20. Right now. But the spread, if you look at the spread, during that same period, we're range bound. We traded a range. So that's a tradable range, and it's $1,000 a point, but it makes it a little bit easier to hold because you're short one futures contract and long the other. So they kind of counterbalance each other, and you're just trading the difference between the two. So that's kind of what the spread looks like right now. Gold, interesting in gold, it moved up. On Bernanke, on Jerome Powell, Power Ranger Powell's comments. You can see here on this daily chart, we broke out of these pivot ranges. We actually went up above the 200 EMA. So where can gold go? You can see another pivot range sitting up here at 1300. You can see this volume over price over here on this market map. We sat here for a long time, from March all the way through to about 4 or 5 months. We sat in this area here, and then we sold off, and then we sat here. And as I've showed you guys before on this chart, what I see gold doing is this right here. You can plot it on a daily or a weekly chart, but you can see this pattern right here, right? So you can see one of these kind of, I don't know if that's what's going to happen, but it looks like a cup and saucer kind of pattern. And you can see this major volume area right there. So that would probably be where it bends down and then goes back up again. Okay. Now this is a weekly chart. So this takes us out into the summer of next year. And then if things start to improve a little bit, it'll pull back on gold, and things start getting ugly, gold will come in. If it breaks out of the top of that pattern right there, then we're off to the races, and we'll challenge this 1360, and we'll just keep right on going. So at some point, I think gold is going to be really a very interesting trade. On this weekly chart, you can see I've got volume over price sitting at 1280, which is very close to the daily. So we could run up to here. If I put it on a monthly, just to really step it out, you can see here, and I'll let it paint right here, we're just coming up to a monthly value area at 1281. So 1280 is sitting on not only the daily, but the weekly and the monthly pattern. So that, and if you look at the monthly right here, we're just in a pivot high and pivot low range. You can see the pivot low for the monthly in gold is at 1187. The fair value is around 1206, and the pivot high is sitting around 1269. So if we close out the month of December, because again, these are monthly bars here, we're looking at the December contract right now. If we close up above this 1269, that's going to be bullish. Notice here we got this big resistance point here. So for those of you that may be swing traders, you can come into like a like this 240-minute chart. You can see this huge breakout here, nice little trend line run up. And if we take it down even further, let's go into a 2-hour chart. You can see again a breakout here. So we've had a number of breakouts in gold. I wouldn't want to chase it, but gold is moving up on the thinking that interest rates are going to there's not going to be 3 next year, maybe 1. So you can see gold on even down to the 60-minute time frame. I could see a little bit of a pullback to that pivot high at 1249, but that's not very far, right? And then if we really take it into, let's say, a 15-minute chart, just to kind of see, you can see the trade action over the past few days has been very bullish gold, even on the 15-minute chart. There's a little bit of an exhaustion bar up here, so wouldn't be surprised to see a little bit of a pullback to this value area around 1250. We're at 1254 now, and just kind of stabilize and then hold until the Fed meeting. Okay. Once we get the Fed meeting, then gold is going to move. If the Feds come in dovish, you're going to see gold continue its ascent higher. If the Feds come in hawkish, which is very hard to believe, then gold is going to roll off. So a couple of ways to play this. An easy way to do it is just do some bull put spreads underneath some of these value areas. So you can come down here underneath 1175 in the futures market and still get some really good premium in gold. If you look at the call side, you'll see that the volatility is a lot higher in the calls than the puts, just because the markets are pricing them in, because everybody's coming out here and buying calls. So I would not do a front ratio spread where you sell more calls than buy, because gold, if the Feds are very dovish and the markets look very weak, then you're going to see gold just explode. Right? And you could literally see gold over 1,300 by the end of the year if it's very dovish and we get more bad news out of the markets. But being long gold is better than being short gold. And that would be my play on gold. Silver looks the same way, although silver is underperforming gold. And I think on a relative basis, silver probably has more upside than gold. You can see right here on this daily chart, the value area, we're sitting right on it, right? We haven't broken out. Gold, we've broken out. Silver, we haven't. If we come to a weekly chart and we look at silver, you can see here on the weekly chart, we're well below the area up here. So I can see silver making a run up to this 16 area. So on a relative percentage basis and return on capital basis, silver would be the better play. But gold is going to be a good play as well. All right. So these are just some that I see that I like. And then we've got some moves in ag, meats, and softs that we're tracking, as well as some stocks that we're looking at. We've done some other things in the energy market. If we look at nat gas put some people out of business a few weeks ago. I feel really bad for those folks. But here is nat gas right here. All right. And our members, we've got a trade on in natural gas. This is a weekly chart. If we come in and look at it from a daily perspective, you can see just how elevated this is. I mean, we're so far north of a value area. Let me put it on a monthly basis just to kind of show you guys. In the scheme of things, it doesn't look that bad. I mean, you can see here we've got a pretty heavy resistance point around that 5 area right up here. We haven't been above this. I mean, if I were to plot it going back to 2009, we did have a spike in 2014 up to 644. But none of these spikes last. Okay. The last time we had really enormous moves was back in 2008 and 2005. I don't see that happening. It could. I don't see it happening. If we look at the daily chart here, it seems the proclivity of this is to find a support area here and a consolidation area before moving lower. Now, this weekend we'll get some cold weather coming across the U.S., so we're going to probably see a little bit more of an upward momentum in this thing. But I do believe that this thing has probably about reached its apex here for nat gas, at least for the time being. All right, everybody, that's kind of where we're sitting right now. Members, I will see you this Sunday evening. If you're not a member, I highly encourage you to come in. We're trading everything from commodities, currencies, futures, equities. We got a lot of things going on. So far in our secret trader, we've got some nice trades that are working out for us. And for next year, I think it's going to be an even more interesting and telling year for the markets. Members, I'll see you this Sunday night. If you're a non-member, come on in. Like to see you on the inside. Have a great weekend, everybody. Take care. I'll talk to you later. Ciao, folks.